Coming up on Business Incorporated. International Monetary Fund says no financial support for Zimbabwe. East Africa community members tussle over external tariffs. And Kenya plans third economic stimulus package. Welcome to the program. I'm Ladi Williams. First off, let's see what's happening in the markets. We'll begin on the African continent, where most indexes across the regions were mostly negative. Nigeria's all-share index reversed Tuesday's positive close at intraday. It slipped marginally by 0.04%. And we see Egypt's index there dropped by 0.12%. While Kenya's key index fell by 0.17% in yesterday's trade. Meanwhile, Johannesburg Stock Exchange was up almost 0.5% at intraday. And it's also negative sentiment across board for the Middle Eastern markets, particularly in the Dubai index, which went down by 0.65% at intraday. Abu Dhabi index flopped by 0.18%. Qatari index fell by 0.29%, and Saudi Arabia was unchanged at intraday. All right, now for more in Europe now, let's cross over to Frankfurt, where we have Christy Platzen standing by. Great to have you, Christy. Well, the EU is considering banning imports of foods like coffee, beef, if they come from areas at risk of deforestation. What countries would this impact?
Yes, that's right. We heard from an EU commissioner, or I should say an EU commissioner told the Financial Times that Brussels is considering targeting 6 specific agricultural commodities in a draft of legislation that, would fight deforestation, as you said. And ultimately, this legislation, it would be less targeting countries and more targeting companies that sell these products, basically forcing them to prove to the bloc that that they are not contributing to deforestation with these products that they want to import into the EU. So this would include, yes, coffee, beef, soy, palm oil, among other items as well. They're also considering adding rubber. So these 6 listed in the draft, though, they account already for nearly 20% of commodity imports into the EU. So this would really have a hefty effect. This is very timely because we just saw all the countries coming out of the COP26 climate conference these last 2 weeks actually committing to end global deforestation by 2030. So this would certainly do a lot to contribute towards that. So, but this is still just a draft, discussions to be had, and ultimately the European Parliament and EU leaders will need to approve it first.
Right, and we see Germany, they're planning to introduce new pandemic legislation to manage what is currently its worst outbreak since the pandemic began. Is another lockdown in the works here?
Yeah, that's a great question. What we saw yesterday is Germany reporting its highest number of new infections of all time for COVID-19, I should say. And this comes at a very precarious time for the country in terms of leadership, because Chancellor Angela Merkel is currently transitioning out of her position, and we have lawmakers in the process of trying to form the country's next government. So it's a bit of an odd moment to try to sort of manage this pandemic. So the current measures in place are going to expire next week. We're expecting lawmakers who are likely to form the next government to come out with a proposal for the next set of measures later this week. And what we've heard is that they plan to include basically restrictions for people that are not vaccinated against COVID-19 or who have not recovered from the virus. So one politician from the Social Democratic Party called it essentially a lockdown for the unvaccinated. I think that would be the best way to understand what they're considering. This would include requiring testing for this group of people in order to go to work, in order to use public transportation. So politicians are really trying to avoid a lockdown for society as a whole here with these measures. Yesterday, DW heard from a leading German economist who said that lockdowns pose less of a threat to the country's economy than infections do. His point there being that if infections are very high, people are going to be afraid to go out and spend money, especially especially during this Christmas season, that could be a big punch to the economy.
Right, lockdown for the unvaccinated. Quite interesting there. German regulators have suspended the certification process for Nord Stream 2, the controversial new pipeline meant to bring Russian gas to Europe. What is this current energy crunch? What does this mean for the current energy crunch in Europe right now?
Right. So regulators have temporarily suspended the certification process. And why have they done this? They essentially told the Swiss consortium that's behind this pipeline that they need to first form a German subsidiary that would then be liable to German law if they want German regulators to approve this pipeline's use in Germany. So with this suspension, this means that gas is unlikely to flow through this pipeline until at least the middle of next year. So that means we won't be seeing a new source of energy here in Europe early next year, and definitely not in time for the winter 2021. So this suspension is currently a major victory for critics of the pipeline, I should say, and this includes both environmentalists who were against investing in new sources of natural gas, and also other European powers, and as well as the United States, who have been against becoming further reliant on Russian energy. So that option's off the table now for dealing with the energy crisis this winter, this crunch that you mentioned. I think Russian President Vladimir Putin had been using these high energy prices as something of a carrot or maybe a stick, depending on how you look at it, to get regulators to push through this approval. That's not going to happen now. So Europe is going to have to rely on the current sources it has or try to find new sources. So it's looking like it's going to be a cold or at least an expensive winter here in Europe.
All right, Chrissy Platson, right there in Frankfurt. Thank you so much for the update.
Thank you.
All right, moving on to Asia now. We see declines across Asia-Pacific stocks seen by today's close, with data showing Japan's exports growth hit an 8-month low, with markets in the U.S., however, were lifted on the back of stronger than expected retail sales data. Australia and South Korea led losses in the region. In Australia, the S&P ASX 200 fell 0.68% to close at 7,369 points. Financial stocks were lower, with the Commonwealth Bank of Australia leading losses as its shares plummeted more than 8%. Mainland Chinese stocks bucked the regional trend. The Shanghai Composite was up 0.44% to 3,537 points, while the Shenzhen Component rose 0.67% to close at 14,711. Hong Kong's Hang Seng Index dropped 0.4% in the last hour of trade, while Japan's Nikkei 225 was up 0.40% at 29,688 points, while the Topix Index was at 0.61% to close at 2,038 points. Stock futures were a little change in early trade today ahead of earning reports from big box retailers, Target and Lowe's. Futures on the Dow Jones Industrial Average slipped by 4 points. The S&P 500 futures and Nasdaq 100 futures were little unchanged. The move in the futures trading come after fresh economic data and corporate earnings signaled U.S. consumers are ramping up spending despite rising prices. Investors await more retail earnings today from Target and Lowe's, Bath & Body Works, and Victoria's Secret. Other major companies reporting results today include Cisco Systems and NVIDIA. And over to the UK now. UK Consumer Price Index inflation came in at an annual 4.2% in October, its highest for almost a decade, with energy and automotive costs soaring. Let's talk to Juliana now, right there in the UK. Juliana, great to have you. I'm sure investors are still, digesting the UK inflation data released earlier today, soaring to a 10-year high. What are analysts saying?
Good afternoon, Laddie. Well, analysts are saying that it's almost certain that the Bank of England will raise interest rates over the next couple of weeks. Will it happen during the Monetary Policy Committee gathering in December? Only time will tell, but it appears as if this data really is the final hurdle that needed to be crossed to change the MPC's mind. As you said, inflation here in the UK in the month of October has surged to 4.2%, almost a decade decade high. I think Reuters conducted a survey from economists. They had anticipated about a 3.9% rise, but 4.2% is more than double the 2% target from the Bank of England. As you were just saying, fuel prices and energy prices are right at the heart of that. Last month, the regulator, Ofgem for energy, they increased the cap for household energy by 12.5%, and this has significantly been reflected in the data. One of the issues is that it's likely to get much higher than that. Andrew Bailey, the Bank of England governor, was speaking in the House of Commons on Monday, and of course the Bank of England get more forensic data. They've priced in about a 4.5% rise during this month, and it could peak at 5% next month. We also had data from the Office for National Statistics on Tuesday showing how the labour market is responding to all of this, and the labour market is doing pretty well. Unemployment has fallen once again to about 4.1%. There are over 1.25 million vacancies. There had been some anticipation that perhaps the end of the furlough scheme would bring many redundancies. That hasn't been the case. So it seems as if now all hurdles have been crossed. Will interest rates rise from 0.1%? It's more than likely.
Furlough scheme there, but I remember the markets were quite muted earlier. How are the markets reacting now?
Well, the markets have reacted negatively, apart from banks, of course. Banks haven't been as profitable since the 0.1% interest rate was put in place, so no surprises to see Lloyds and NatWest rising by more than 1%. The rest are all down. FTSE All-Shares down 0.29%. The FTSE 100 down by 0.30%, and the FTSE 250, that's down by 0.06%. In the currencies market, the British pound continues its rally against the US dollar. That's up by 0.08%. It's also up against the euro by 0.18%, and the British pound is trading flat against the Japanese yen at intraday.
All right, and a property company, British Land, the owner of shopping centres, including Sheffield's Meadowhall, has announced a multi-million-pound plan to turn car parks and empty shopping centres into urban distribution hubs. Tell us about this.
Yeah, the urban logistics opportunities has risen significantly during the lockdown. We know lots of people, of course, couldn't shop at non-essential stores, so they were spending billions of pounds online since that time. Apart from the big titans like Amazon, Pretty Little Thing, Boohoo.com, there have been other smaller players that are now attracting billions of pounds worth of investment. Some of them include Getir, Gorillas and Wheezy. Now, what they are doing is promising customers that they can get your shopping to your doorstep within an hour or two. And because of the expansion of this market, space has become a premium. So British Land, of course, they are a major player providing a space for offices and retailers. They hadn't been doing too well during the pandemic. There were many laws that prevented them from kicking out tenants that weren't able to pay rents. So they suffered and decided to change their strategy. They've announced a trade update showing they've returned to profit since lockdowns have been lifted. But now they're going to start purchasing these kind of abandoned spaces or underground car parks to offer distribution spaces for these new, fast delivery apps. So seen as a win-win, profitable sector, and that's urban logistics.
Right. All right, Juliana, thank you so much. I'll talk to you tomorrow.
Thank you, Laddie.
All right, after the break, we'll look at burning issues on the African continent. That's in a moment. Do stay with us. Welcome back. So it's day 3 of the Intra-Africa Trade Fair 2021 happening right there in Durban, South Africa. Let's bring in our correspondent now, Teniola Shubowale, for an update. Great to have you, Tenny.
Hi, Laddie. Good to see you too.
Great to see you, and I'm sure you're going to bring a lot of goodies for me from the fair. But speak to us about some of the outcomes from day 2 yesterday.
Well, so Nigerian companies yesterday signed about $1.5 billion worth of deals. Two of those were focused on the oil and gas sector. And I think really one of the most impressive ones was with Abla Bashir, the group managing director of AA&R Investment. Well, he became the youngest man to sign a deal worth over $100 million with Afrexim Bank. So that was really impressive. And then we had the visit to Nigeria's pavilion by former President Olusegun Obasanjo. And as we know, Nigeria is gearing up to showcase its investment and trade opportunities on its country day, which is on Thursday. So that will be quite interesting. Other than that, yesterday, all eyes were kind of on Egypt, as it was their country day, where they presented trade and investment opportunities at their pavilion.
Focus for today.
Well, involving today, we've had Côte d'Ivoire, which is today's Côte d'Ivoire's country day. And we also got the announcement that the country will be hosting the third edition of the fair in 2023. So that's exciting. Going into the afternoon session now, which is now, the focus is really on the role of policy infrastructure and the harmonization of trade standards to facilitate the intra-African trade and investment. And soon, I think that's happening now, we'll be hearing from former President Olusegun Obasanjo. He'll be speaking on the merits of the IATF and how it can further cement its brand value and the exhibition to drive trade and sustainable prosperity across the continent. So as that happens, we'll be giving you all the details. Laddie.
All right, Tanya Olashobowale, right there, Durban. Thank you so much.
Thanks, Laddie.
All right, on to East Africa. Now, there's been a controversy about external tariffs between member countries in the East Africa community, as East Africa's private sector is pushing for the adoption of a 35% tariff as the fourth and maximum common external tariff for East Africa community, talking about the EAC member countries, while the three other countries in the bloc, that's Kenya, Burundi, and Rwanda, want 30% as the maximum common external tariff. Well, how would all of this impasse affect trade in the region? Let's bring in Mercy Milanoy, business journalist at Mula Media, Kenya. Great to have you, Mercy.
Oh, thank you so much, Laddie.
Yes. So
this discussion actually...
This 30 and 35% tussle for external tariff, what is the real issue here?
Well, basically, every country is trying to see how they can protect their industries and also ensure that they leverage more on the industries they're producing at home as compared to importing. As you know, that this discussion has been ongoing for a while, actually better part of 2021. And of course, it's just to see how, as a bloc, first of all, how they can protect their industries, while at the same time, how they can reduce the influx of imports from other countries such as China, India, and the rest, to make sure that the East African countries, the industries and the manufacturers are able to meet the demand of the goods and also products that we are mostly importing, as compared to depending on the imports that we have. But also there has been a debate as far as the external tariff, whether it's 35%, 30%. There was also a proposal for 40%. But of course, now with countries not being on the same side as far as what percent to be able to agree on, from what we are seeing is that most of these countries, especially Rwanda, especially the landlocked countries, the main debate is if they are able to depend more on their industries, then of course they'll be able to depend more on what they're producing at home. But the question is, are they able to meet the demand? And of course, for other countries, they're like, okay, fine, we want to protect our industries, but at the same time, we're still not able to meet the demand. So that's mostly the debate that is going on within the East African countries. Interestingly, actually, last week there was a meeting. In fact, from the latest news we have received from EAC newsletters is that that's one of the things that was discussed last week. And of course, we're expecting at least for something comprehensive from the ministers of trade before the end of the year. Probably, maybe we can have a consensus before the end of the year, before they close business for the year, Ladi.
Pending the consensus, how will this impact trade for the EAC bloc members?
First of all, as EAC, there are already issues among the countries. As you know, there's some products, especially LPG gas and milk, that we have a bit of issues getting into Tanzania, reasons why the president came to visit Kenya in the first place. Also, you find that with Kenya and Uganda, there are a bit of trade issues. So first of all, there are a lot of, before even you get even to to get to the tariffs, there are a bit of issues among the countries themselves, which are making it a bit difficult for goods to actually get through to the different countries. So that's one of the issues that the ministers are looking to solve first. Reasons why presidents of the East African countries have been visiting and deliberating among each other, even the ministers visiting and deliberating among each other, and especially the private sector, because they are at the center of this. If they're not able to come into consensus, first of all, with the tariffs and the taxes that are being imposed on goods crossing each other's borders, then it's also crippling the private sector and manufacturers. Also, now coming to the tariffs, you find that if they're not able to agree, you find that there are some manufacturers who will be on the losing side, because then it means that there are goods which will be coming in that are still able to be produced within the countries. So for right now, it's the private sector that is actually really pushing for the ministers to come into consensus, because at the end of the day, the other producers and the goods, and it's the businesses at stake.
Right, that would definitely affect and impact their businesses negatively if there's no consensus. All right, Mercy Milanoy, thank you so much, business journalist at Mula Media, right there in Kenya. Thank you for coming on the program.
Thank you so much.
All right, the International Monetary Fund has said that it is unable to offer any financial support to Zimbabwe due to its unsustainable debt and outstanding arrears. According to the IMF, a funding financial arrangement would require a clear path to comprehensive restructuring of Zimbabwe's external debt, including clearance of arrears and obtaining financing assurances from creditors. Zimbabwe has suffered from bouts of hyperinflation in the last 15 years. It has not received funding from lenders like the IMF and the World Bank for more than 2 decades due to arrears. The country has more than $10 billion in debt, most of which is in arrears. Exports of Algeria's Saharan blend crude hit a more than 2-year high, buoyed by a rise in shipments to the country's core markets in northwest Europe and the Mediterranean. Saharan blend export increased by 30% on the month to 580,000 barrels per day in October, the highest monthly volume since August 2019. According to Argus tracking data, analysts say there was reduced domestic demand in September and October, boosting the amount available for export. The increased interest from those regions coincided with rising propane prices in Europe, which prompted some petrochemical producers to switch to naphtha, an ethylene feedstock, supporting demand for naphtha-rich crude like Saharan blend. And Kenya plans to inject 26.2 billion shillings into a third economic stimulus package to accelerate recovery of key sectors of the economy hit by the COVID-19 pandemic. This will bring the total stimulus package to more than 79.9 billion shillings. We spent about 53.7 billion shillings in the first stimulus program launched in March last year. It was followed by a number of relief measures in the second phase. Sectors to be supported include agriculture, health, education, drought response, policy, infrastructure, financial inclusion, energy, and environmental conservation. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye-bye.